Our stock portfolio is crushing the S&P 500 by 89% so far this year. In this video, we're going to walk through the top 5 stocks in our $1 million stock portfolio.
So here's a chart of how our portfolio compares against the S&P 500 so far this year. And as you can see, the S&P 500 is up almost over 9%, and our portfolio is up almost 17%.
One of the top 5 stocks in our portfolio is Salesforce, and it is a cloud-based software company, and they provide businesses with tools that help them find more prospects, close more deals, and provide a higher level of service to their customers.
The year-to-date performance of Salesforce, believe it or not, is 54%. The fair value that we're looking for on Salesforce is $242 per share. Okay, so let's walk through some pros and cons about Salesforce. Let's start with the pros. So one thing that we like about this stock and this company is that it has a 25% debt to equity ratio. It has a 73% gross profit margin, which is pretty incredible. And it has a 1,134% average EPS growth forecasted over the next 3 years. It also has a wide economic moat, which is something that we look for in all of our top investments. Salesforce also dominates the Salesforce automation space, as you would guess, but it still only controls 30% in a highly fragmented market. And that continues to grow in double digits, but this suggests that there's still a lot of room to run. The company's added to their overall growth, including customer service, marketing automation, e-commerce, analytics, and of course, artificial intelligence.
So now for the cons of Salesforce. So Salesforce has entered new areas via acquisition and has arguably paid material premiums in the process, which makes the integration risk very real for that company. Despite its size, Salesforce has generated lower margins in the recent years, and its renewed focus on profitability may actually negatively affect the already slowing growth that it has. And there's also the continued risk that large corporations will leave Salesforce and build a similar CRM platform internally in those companies.
Yep. So now as far as what we plan to do with this investment, as far as buy, hold, or sell, we do plan to hold this investment. We're fully allocated, which means we bought all of it that we wanted to as it bottomed in this recent bear market. And so our plan is to just hold it and buy more. Again, we're willing to go even over the allocation that we wanted if we find that this falls below fair value again, because it's just such a great company, right, and something that we want to have a lot of in the future.
Right. Another stock that we have in our portfolio that falls in the top 5 is AMD. AMD actually produces semiconductor products and devices. The company also offers products such as microprocessors, embedded microprocessors, chipsets, graphics, video, and multimedia products.
The year-to-date performance on AMD is 57% so far this year. And the fair value that we have for AMD is $99. All right, so let's talk about some of the pros, things that we like about AMD. So first is that it has a 5% debt to equity ratio, which is pretty amazing. It has a 51% gross profit margin, which is great. It has a narrow economic moat, which is also great. I mean, it's not a wide moat, but it's narrow, so we'll take it. It also has 103% average EPS growth projection over the next 3 years, which we really like that, so a lot of growth potential in the earnings per share. AMD's recent CPU and GPU offerings have made it more competitive with Intel and Nvidia's products. And relative to Intel and Nvidia, AMD is the only one that boasts an x86 CPU and GPU. And that could be a huge benefit because a lot of companies, the market's shifting for computing is shifting to workloads that need both a GPU and a CPU. And in this case, AMD has both. Right. So it has an advantage over Intel and over Nvidia, which just has one of each for the most part. AMD has also set its sights on the dominant CPU market share, and it has the EPYC server chip that's proved to be comparable or even superior to Intel's chips. So that's pretty cool too.
It's awesome. Now, though, the opposite side, so with the cons, with what we don't necessarily like about AMD is that Intel is actually the dominant player and holds long-term advantages over AMD in both R&D, marketing, and pricing. Nvidia is also ahead of AMD in the GPU technology and has also been very incredibly successful leveraging its GPUs. And AMD's lack of size might make it difficult to maintain any momentum against Intel and Nvidia, which have considerably deeper pockets in that realm.
So there's a lot of good things about what we like about AMD, some things to think about that are negative, and overall what we're going to do as far as our next steps is we're going to hold and we're going to buy a little bit more if it falls under our fair value target of, I believe this one was $99.
Yep. So another stock that we have in our portfolio is Shopify. And in technical terms, Shopify is a subscription-based software as-is service or a SaaS sales platform. And this e-commerce platform offers an easy way to start selling products and accepting payments online.
The year-to-date performance of Shopify is shockingly 73% so far this year. That's pretty amazing considering it's only May
right
now. The fair value that we see for Shopify is $44 per share. So let's talk about some of the things that we like about Shopify. It has a 17% debt to equity ratio, so you can tell a lot of these stocks have that same similar thing in common. It has a 48% gross profit margin, and it has a narrow economic moat. It also has a 79% projected EPS growth over the next 3 years and a 21% revenue growth over the next 3 years. So as you can see, growth has been strong, and it's expected to remain strong when they're adding new merchants, and they also have their high attachment rates. It also offers a simple turnkey solution for small business owners, and it's easy to use and attractive, which that makes a lot of sense. They also have a large referral and developer ecosystem that allows these small businesses to get quick access to website development, design, and photography to enhance their sites.
But there are some cons to all this good stuff that we're hearing. The stock price is high above fair value at times, and Shopify might not be able to live up to everyone's expectations. It's also exposed to an economic cycle since small businesses have a high rate of failure and retail volume declines during downturns. The Shopify fulfillment network also requires a big investment in resources and capital.
So for this one, as far as what we're going to do next, honestly, this is one that I've been watching for a while, but the price has always been really high, and up until this recent bear market, we haven't had any of Shopify, just because that value, to us it was beyond the fair value, and I just wasn't willing to take the risk on it. But during this bear market, we did buy some, but we're only about halfway to what we would like to buy. So this is one that we're definitely going to be keeping a close eye on and buying about doubling the position that we currently have to get to looking for about 2% overall in our portfolio.
So the next one that we have here is Meta, which is Facebook, as we all know by now. Meta's mission is to build technologies that help people connect, find communities, and grow business. It operates actually in two segments, the family of apps and the reality app labs. The family of apps segment offers Facebook, Instagram, and Messenger, and then the reality lab segment provides augmented and virtual reality related products.
Now, are you ready for this one? The year-to-date performance. Again, the S&P was about 9% so far this year, and Meta is at 98%.
It's amazing. That's crazy.
And I will say though that a lot of that is because it fell so far during the bear market. I mean, this thing was like dead. Nobody wanted to touch it. Nobody wanted to invest in it. But it has always been on the top of our list, so we were really happy to see it fall. And as it kept falling, we kept buying. So we are at our full allocation at this point on this one, but we still might like to buy more. But I don't know. We'll see. And the fair value that we see for Meta is at $279 per share. Okay, so let's talk about the pros and cons for Meta. There definitely are both. So one of the things we like, again, with the debt to equity ratio, Meta has a 23% debt to equity ratio, which is great. And what we like to follow is what is Warren Buffett's advice, which is basically if it's under, I think it's 50% debt to equity ratio, then that's what he advises to look for in value investing. So that's 23%, that works even below that point. It also has an 80% gross profit margin, which is fantastic, and it has a wide economic moat. So those are three things that we really like and we really like to look for. They also have more users and more usage time than any other social network. And this gives them the largest audience and the most valuable data for social online advertising. That's awesome. We like how Meta is starting to incorporate artificial intelligence into their existing platforms and products. And they're also launching VR products, which we like that too.
Right.
And we hope that this is all going to increase their user engagement, driving their growth and their advertising revenue.
Right. So we all think that Meta's great, and it is great, and it's been, it's been in our lives for a long time.
That's true.
But there are some cons to this stock and to what we see kind of like with it. Meta is very dependent on online advertising growth. If advertising dollars shifted to Google and Snapchat, it would have a major impact on them. Despite that rapid user growth that we talked about, they continually have to fight with TikTok and Snapchat to capture their users' time. And their future regulations could limit the user data collection and restrict how it is used, which negatively could affect their growth again. So
yeah, I feel like not too long ago, they were in battles with the government about various regulations. It seems like every year they're battling with something. So that's
all right.
The cons are real, unfortunately. You've got to take the good with the bad on this one.
Right.
So as far as our next steps on this, like I mentioned earlier, we're at a full allocation. We pretty much bought all the Meta that we wanted and some. And we might even sell some if it gets to a higher valuation, if it goes too far beyond what we believe the fair value is. And then we may buy it again if it goes below that later on. But we're pretty happy with where we bought this, and we bought a lot right at the bottom. So
yeah,
we're good.
Okay, so the last one that we're gonna share with you guys, and that's the top 5 stock in our portfolio, is Nvidia. And Nvidia is a pioneer in accelerated computing. They actually invented the GPU in 1999, which sparked the growth of the PC gaming market. They've redefined computer graphics, they've ignited the era of modern AI, and they're fueling the creation of the metaverse.
So the year-to-date performance so far, definitely saving the best for last, is 101% so far this year, which is pretty incredible, again, compared to the S&P 500, right, that's at a mere 9%.
And we're only in May, not even halfway through the year.
The fair value is $251 per share. Okay, so let's talk about Nvidia a little bit more and talk about the pros and cons and then what we want to do next with this company. So first of all, they have a wide economic moat, which we love. It has a 54% debt to equity ratio and a 57% gross profit margin. All those things are fantastic. It has also a 72% projected EPS growth and a 19% projected revenue growth over the next 3 years, which that's great too. So it looks like it's poised for even more growth over at least the next 3 years. That's usually what we look at. And it has a massive growth opportunity with AI, as you would expect, in deep learning, relying on Nvidia's graphics chips. The big advantage, it also has a big advantage in the automotive industry with the autonomous driving market, and it could lead to widespread adoption of its Drive PSX self-driving platform.
So again, those are all really cool. Everything sounds great, but there are some cons, that we see with Nvidia, and just some things that we want to keep our eye on as we move forward with this. AI is actually just, it's just coming into existence and it's showing signs of potential, but no one's really certain what Nvidia's GPU is how it's going to dominate, or how anybody's going to dominate in that field, because it's also new. On the automotive front, they face plenty of competition from numerous chip makers, and a large portion of their sales come from maturing PC gaming industry. So
that's not great. So as far as our next steps with Nvidia at this point, we do still want to buy some more. We have a decent amount towards our allocation, but we do want to buy some more as it falls below fair value, and we're targeting 2% of our portfolio for Nvidia. Okay, so there you have it. That's the top 5 stocks in our portfolio that's beating the S&P 500 that's at 9%, and our portfolio is at about 17% so far this year. We do plan on keeping an eye on that and doing future updates, and also expanding our portfolio, giving you guys a little more information about what other stocks we have. That's coming up, and we'll also see how well our portfolio compares to the S&P 500 throughout the year.
Right.
So if you guys liked the video, if you liked everything that we're talking about, please give us a thumbs up. Reach out to us in the comments below, and you can also email us or follow us on Instagram.
And our goal here is to read every comment and respond as often as we can. So make sure to subscribe to our channel and join us as we learn, save, and grow together.
Thanks, guys.
Bye, guys.